Hello and welcome. Today we'll talk about smart money concepts. I'll show you how to read the market before it moves, and you'll learn how to anticipate where the market is going next, based on simple logic and the power of liquidity and imbalances. So if you could, like and subscribe to the channel and stick around for the whole video. Smart money concepts have become very popular in the Forex trading community. So let's explore what smart money truly is. According to Investopedia, smart money is the capital that is being controlled by institutional investors, central banks, and other financial professionals. So now that you know the central banks and institutional investors control the market, how can you, as a retail trader, take advantage? First, let's understand the three phases of the market. Consolidation is just a phase where a currency pair, stock, or index stays within a range. The trend is said to be sideways and may change depending on the situation. As soon as this range is broken, it can lead to much bigger moves, but until price breaks out of that range, the movement cannot be clearly predicted. This ping-pong range of price is caused by low institutional volume. This is also seen as market indecisiveness. The second phase is the manipulation phase, where we see increasing institutional volume. Smart money generates liquidity in the market by manipulating or trapping retail traders in bad positions. As price breaks out of consolidation, they can entice novice traders to take trades in the wrong direction by pumping volume into the market. This is where most of the fake outs happen, where you either get stopped out or have your pending orders activated, which leads us to the next phase. The distribution phase is when institutional traders start to take profits from the market. This is when the market makers make huge moves in either direction and traders are using momentum-based liquidity to exit previously accumulated positions. This is where most FOMO retail traders make temporary profits. So now that you see how the market makers accumulates orders through consolidation periods, then manipulate you into taking a trade in the wrong direction, let's explore how you can get on the right side of the market, follow the institution's footprints, and become a more profitable trader. You use these areas of liquidity to anticipate where price will most likely draw to next, thus predicting the next move. You increase your probability of predicting the next move by aligning with time. This is where having a fundamental understanding of how the big institutions manipulate the market using macroeconomic data. By knowing the day and time when there's an economic event or data release, you can use that to gain your edge. You want to aim to have a clear understanding what is moving the market on that particular day and time. So head over to tradingeconomics.com and click the calendar tab. Filter by high impact events only. Find the country associated with the currency you like to trade, then locate a date and time when the economic event will be happening. Now that you know what economic event is taking place, you need to decipher what that data actually means and how it can affect price movement either negatively or positively. Let's say if you determine that the Fed has a policy rate decision to make on May 5th at 1 p.m. And the expectation in the trading community is that the Fed will most likely raise interest rates. That could help you determine a bias. Because if the Fed were to do what the market is expecting and raise rates, then you know more than likely the US dollar could see some strength to the upside.
Daily, about a 75 basis point move. What did we get?
Well, they're basically singing from the same hymn book, as they say, monetary policy hymn book that is. And basically, what Jay Powell said is that he does expect 50 basis point rate hikes at the next couple of meetings if the economy performs as expected.
Conversely, if they were to lower rates, that could be a sign of weakness, and you can anticipate to see the US dollar spike down. So now that you have done your fundamental analysis and understand how this event can influence price movement, you can align time of that event together with your technical analysis. So when reading institutional order flow from a smart money perspective, you should look for where liquidity and supply and demand is on your charts. We can spot these areas of liquidity from previous areas where there were double tops and double bottoms. This is also known as equal highs or equal lows. Mark out those levels on your chart. Then you want to make out previous daily highs and lows followed by session highs and lows. These levels can give you a trading range. Within this range, you'll next want to find supply and demand. Supply and demand is just another way of looking at bullish or bearish order blocks. A bullish order block can be seen as a demand zone where you have that last down candle before the up move, and a bearish order block can be seen as a supply zone where you have that last up candle before the move down. So far in this example, you have already identified an economic event that will influence price movement on that day and time. So you now have a solid fundamental bias intact. If the overall market expectation is the Fed will be raising rates, then you can anticipate to go long on the USD, thus giving you a bullish bias. So let's pretend you come to the charts that day and you have already identified the liquidity, imbalances, and supply and demand zones on the higher time frame to determine a technical bias. After you have determined a higher time frame bias, go into your intraday charts and locate the session's highs and lows. Circling back to your fundamental analysis, since you know the Fed's rate decision is at 1 p.m. during the New York session, you'd ideally look to frame a trade setup around that time. So before that time comes, you want to sit back and analyze the London session. Ideally, you'd like to see London drop price to create an imbalance or a bullish order block. In this example, we have established a bullish bias, so we can anticipate the market manipulation to take place during the London session. So we would be looking for London to make the low of the day and the current London high or previous day's high as the next draw on liquidity. Prior to the time of the economic release, you want to look for a point of interest. Preferably, you would like to look for an obvious imbalance or order block. Now that you have your point of interest mapped out on your chart, you allow the market to react to the initial data release. Then wait for the market to absorb that news and look for the manipulation to the wrong side, trapping dumb money or other retail trade.
Trap is set, cheese is in it.
Let's say the data is released and it's positive and meets market's expectations. Then you would look for the trap and anticipate the initial move to be bearish, enticing dumb money to take short positions. Meanwhile, you have already identified your point of interest and entry to go long. You patiently wait and allow the market makers to manipulate, and you take your entry and collect profits. Now you look like a trading genius. But it doesn't stop there. You already have one profitable position running. Your next goal should be to find potential opportunities to add to your current profits. You can essentially increase your risk to reward ratio by taking a second or third entry to maximize just one trade. To do this, you need to understand something. If you really want to be a consistent trader, it's going to come down to you simply paying attention to the three phases of the market maker's pattern. And that's the ability to see if we are in a consolidation, manipulation, or distribution phase. Next, you need to identify liquidity, imbalances, and order blocks. Those are the highs, the lows, the double bottoms, the double tops, as well as your bearish and bullish order blocks. You also need to know the macroeconomic data and the day and time it's scheduled to be released. And then finally, you need to have a good risk management plan that gives you high risk to reward ratios. You can listen to everything that I just shared with you, but if you are not choosing the right order blocks, your trading will not be as successful. Lucky for you, I just made a video about how to find the right order blocks for most profits. So please check out the video that I'm going to put up on the screen next. It's going to tell you the exact way to trade order blocks. I suggest you check it out if you're serious about becoming a full-time trader.